let's swing it to some stocks. Couple of picks, Tyson. Chris,
Man, I'm going to come back. I sound like a broken record, and I have been wrong, but early. I'm going to tell you what I told Equities on Demand students. I've got two favorite stocks right now, two of my largest positions by far, in Skills, SKLZ, and Beachbody, BODY. I'm going to continue to buy them. They've been going down. I've been using this weakness as ways to dollar cost average in. Might be wondering, well, geez, at what point are you going to sell? What point are you going to, admit when you're wrong? Honestly, listen, I'm not married to the position. I will admit that I'm wrong, and I will change my stance. We've done this before in other stocks. I will do that if the story changes. The story still hasn't changed. I like the companies fundamentally. Those are my two favorite longer-term plays. Saying that, I think there's some really, really good shots that you could take. I'm going to tell you right now, I think a stock like Twitter, a stock like Facebook, you want to make some quick bucks over the next 1 to 2 weeks, I think they're due for a nice bounce. I think they're getting beat up for the right reasons, but I think they're going to bounce fairly aggressively. I've got a lot of credit spreads in this week in stocks like Twitter and Moderna and different things like that. But there's another thing we were talking about real fast in Equities on Demand is like we've been looking for the sell-off. There are stocks out there that have sold off down to very valuable levels. For those that want a little bit more conservative portfolio in like blue chip style, amazing multi-tens of billions, hundreds of billions of dollars worth of companies. Two of my favorite plays is Magna, MGA, which is an electric vehicle manufacturer. MGA is the balance sheet is absolutely beautiful. It's amazing looking, a lot of cash. And then Micron, MU. Those two right now are trading at massive value. They're trading like deep discount value stocks, but they have like 20, 30% forecasted growth rates. And they have great balance sheets. So MGA and MU are like two of my favorite. Sock away, buy, forget about them for 5 years, 10 years, and you'll probably end up doing really, really well. So
I like it.
right.
We talked about those this morning. I know that we'll talk about this more in Equities on Demand this week, Tyson, but we keep talking about all these great stocks, healthy stocks. I used one of my scanners from Simply Wall Street and just found really, it's interesting. I just did a pure value play because you and I have talked about this. Look, we're clearly seeing like a little bit more of accelerated sell-off in tech. So, Facebook has been dropping. Microsoft is finally coming down. Apple is coming down. Amazon's coming down. Netflix is peaked out, starting to sell off a little bit. So tech, just like we saw with the just insane concentration in so few stocks, if tech is dropping, it will bring the entire market with it. So as tech is correcting, we are starting to notice this transfer from, low interest borrowing, R&D, put money back into your company and spend it like crazy like tech typically does, to potentially reining that in. Interest rates go up, blue chips, dividend stocks, value stocks, infrastructure stocks start to get maybe a little bit of the nod for better growth in the next maybe 12 to 24 months. One thing really quickly, Tyson, can you spend like 2 or 3 minutes talking about the kind of the 0 to 7 year sector rotation stuff?
Yeah, good. This is really valuable stuff. I got to tell you, but really, so. Real fast, a definition of a recession, like we just went over, is two consecutive quarters a decline in gross domestic product. So once we go into recession, that's easy to indicate. Okay, so now we're officially in a recession, 2 consecutive quarters of declining gross domestic product. But it's the key is how do we forecast when we're coming out of a recession? So many analysts and so many people they time it wrong. So here's kind of the indication that I use. Look at the jobs number and look at retail sales, because we need those two things. It's going to take the people getting to work and people spending that money to get us out of a recession. So when we get 2 consecutive months of increase in jobs number, not the unemployment rate, but the actual jobs number, when those, I don't care if it goes from, we created 5,000 jobs to 5,200 jobs to 5,300 jobs, 2 months in a row that are higher, the consecutive, and then 2 months higher in retail sales. That's the first kind of key indication we're coming out of a recession. Now, the reason this is important is because when that happens, we reset this kind of 7-year trend. And I'll just give you guys kind of just the quick version of it. There's something called risk on, risk off. It happens in the currency markets and it happens in sector rotation. If you're going to be let's say that we're coming out of a recession, we just got the second month of retail sales and jobs numbers right now. What we want to do is we want to start to go in what's called consumer discretionary. That's when the consumer, you and I, your next door neighbors, we're going to start to feel better. The headlines are going to start to look better than they did a couple months ago because things are starting to pick up a little bit. We want to go into discretionary stocks such as, I'll give you like a portfolio. Right away, you buy Nike. You hold Nike for anywhere from 1 to 2 years. This is just as an example because people are excited. I want to go to the club. I want to do this. I want to buy my Nike. You buy Nike, you hold it for 1 to 2 years. After 1 to 2 years, what happens is interest rates are still low, but people are starting to hear a little bit rumblings of interest rates maybe going up because the economy's starting to get better. You sell your Nike and you go into something like D.R. Horton because now you're going to get a big flood into home buyers, right? Because they want to get into the market and buy before the rates go up. So year 1 to 2, you buy Nike. Year 3 and 4, you buy D.R. Horton, DHI. After year 3 and 4, that's when the rates start to, that's when we really start to get rumblings that the rates are going up. That's when money starts to flood into financials because financial markets, financial companies like Goldman Sachs and Wells Fargo, they do really, really well when rates go up because they earn more money. They get more margin. And so what we want to do is we want to get into those before that big rally happens. So year 4 and 5, we go into financials such as, let's say, Goldman Sachs or Wells Fargo. And then late in the cycle, 5 and 6, when we get into about the 6th year of the cycle, forget all getting the upside, go to safety, start going into more consumer staples because these cycles typically last anywhere from 4 to 7, 9 years at the longest, really. You want to go out of your banks and into something like Procter & Gamble or Walmart. So the way it works is this. We'll say it 2-year increments. You go Nike, D.R. Horton, Goldman Sachs, Procter & Gamble. Wait for the recession to hit. Wait for those signs that were coming out of the recession and restart Nike, D.R. Horton, Goldman Sachs, Procter & Gamble. You do that, and I'm going to tell you, you're probably going to substantially, I can't guarantee it, but that portfolio right there, I would be shocked if it didn't handily beat the market and lose much more when the market goes down. That right there is probably a master's degree in economic, right? in sector rotation right there, by the way.
You meant lose much less, Tyson? When the
I'm sorry, lose much less. Sorry about that. Yes. Yeah. So you're still, I want people to understand, you're still going to lose money in a down market because you're in stock, you're buying stocks.
But the
idea is this. Yeah, if the market goes down 30%, I want my portfolio to go down 15 or 20 or 22% less than the market. And if the market goes up 22%, I want my portfolio to go up 38%. That's what we're trying to do. We're trying to outperform in good times and lose less in bad times.
Another thing as well, I forgot to remind you guys again, if you have not subscribed to the channel, please make sure you do that. Subscribe to the channel. Chris and Tyson and myself, we talk about some great stuff here in this channel. And if you're not a subscriber, you're not going to get to know when we go live. And you need to go ahead and subscribe. So please go ahead and subscribe to the channel, but also smash the like button. That's the way we can get this video out to as many people as possible. That's it from us. We do appreciate you guys being here. We will see you back next week, same place, same time. And we're definitely going to have more conversations about what we spoke about today. Just go ahead and make sure that you post those chats. Go ahead and comment in the chat. With that being said, this is Chris, Tyson, and myself wishing you peace, joy, and successful trading. Until next time, happy trading.